Good morning and welcome to Nikola Corporation's second quarter 2021 earnings conference call. At this time, all participants are on a listen-only mode. We begin today's call with a short video presentation followed by management's prepared remarks. A brief question and answer session will follow the formal prepared remarks. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. As a reminder, this conference is being recorded. We will now begin the video presentation.
So we're up here in upper Midwest at Proving Grounds doing some durability data acquisition. We searched around and found a company that in our timeline, since it's always aggressive, right, would sign up to putting this level of instrumentation on a vehicle. It's a big job even by an instrumentation group standard, you know. These guys did 4 weeks worth of work in 2 weeks. What they're doing is they're collecting load data. We're measuring what the road is doing to the truck. What does a typical road put into the chassis, put into the vehicle?
I think we went through 2 or 3 spools of the strain gauge wire, and that's 1,000 feet apiece. About 60 accelerometer cables, and those are 50 footers, 30 footers. It was a solid, couple weeks. So this is probably 100 times, more sensors than we typically capture.
We have 264 sensors on there. We got wheel force transducers measuring what's coming in the wheels. We got accelerometers measuring the frames, the cabs, the seats. So that way we can take that data and give that to the CEA group so they can do simulations based on that. They can look at load cases. They can do predictive modeling of those things so we can do it virtually.
Yeah, right now we're just doing a torque check. As part of our regular inspections, make sure nothing's loosening up on these trucks as we're testing them, put them through their paces. Cool.
We're here at this Proving Ground facility. Beautiful facility, right? Lots of different areas. But to get up here to the durability area, there's an entrance road that comes up here, and it's a 12% grade on the first entrance to that road. We pulled legal load, 82,000 pounds, up that 12% grade with no issues. So we're traveling up that hill at least 4 times every series of events, and we're doing 100 events. You can pass somebody going uphill pulling your legal loads. What more do you need? Some of the events are targeted to doing just standard road events. And then events like cobblestones and residence roads and impact strips, those are aggressive type maneuvers. It doesn't matter where you take it. It's going to survive. It's going to function. It's going to give you what you need to do. Abuse it to make sure that when you abuse it, it's just as safe as if it were on the floor. It's not your everyday 30,000 mile vehicle that you lease. It's hundreds and hundreds of thousands of miles that this truck is going to be in service and in use. Been doing this 23 years. Where we are now is hands down the fastest nothing to something and getting it rolling and getting it testing that I've ever experienced. The rate of success that we've seen is further than expectations, I think, internally and externally. It's just been a short time frame. We're pushing real hard. You know, everybody's committed to hitting our deliverables, and that's why we're out here when the sun goes down, still testing. Of course I'm proud of what I'm doing, or I wouldn't be here. I have to believe in what I do. Wouldn't do 20-hour days if I didn't love it, right? So we're investing our time into a vehicle that we know is going to be safe and will change, you know, the trucking industry as we know it.
Thank you. It is my pleasure to now introduce Nikola's Chief Legal Officer, Brighton Worthen. Thank you, Brighton. You may begin.
Thank you and good morning, everyone. Welcome to Nikola Corporation's second quarter 2021 earnings call. With me today is Mark Russell, Chief Executive Officer of Nikola, and Kim Brady, Chief Financial Officer. During today's call, we will share our views on the business environment and our financial results for the June 2021 quarter and our outlook for the September 2021 quarter and the full year 2021. The press release detailing our financial results was distributed a little after 6 a.m. Pacific time earlier this morning. The release can be found on the Investor Relations section of the company's website, along with the presentation slides that accompany today's call. Today's presentation and Q&A includes certain forward-looking statements within the meaning of the federal securities laws. Forward-looking statements are predictions, projections, and other statements about future events based on current expectations and assumptions, and as a result are subject to risks and uncertainties. Many factors could cause actual future events to differ materially from the forward-looking statements in this communication. For more information about factors that may cause actual results to materially differ from forward-looking statements, please refer to the earnings press release we issued today, as well as the Risk Factors section in our annual report on Form 10-K and our quarterly report Form 10-Q filed with the Securities and Exchange Commission, in addition to the company's subsequent filings with the SEC. Forward-looking statements speak only as of the date they are made. Readers should be cautioned not to put undue reliance on forward-looking statements. With that, I will now hand the call over to Mark.
Thanks, Britton. Welcome to our second quarter 2021 earnings call. Today we'll provide you with an update of what we accomplished during the second quarter, and I'll begin with an overview of the status of the validation progress of the Nikola tray and some updates on our joint venture manufacturing facility in Ulm, Germany, and our facility in Coolidge, Arizona, our announced investment in a 20% stake in Wabash Valley Resources, a clean hydrogen project in Indiana, and then lastly I'll update you on the most recent development, which was an expansion of our sales and service network. After the business update, Kim will discuss the financial results, give you some color on our purchase agreement with Tombstone Capital, and of course we'll do our best after that to answer your questions. So let's kick off with the Nikola tray battery electric vehicle update. Validation activities continue on the first batch of the 5 alpha trucks. We've also now completed all 9 of the beta trucks from the second batch. 3 of the trucks from that second batch have been commissioned and are undergoing validation, at various proving grounds around the United States. The remaining 6 of that batch are in commissioning here in Arizona right now, and then will be at various proving grounds for validation testing by the end of this month. This second batch of beta trucks have incorporated the component improvements and systems improvements that came from testing the batch 1 alpha trucks to date. We've also started building gamma trucks in Coolidge and Ulm plants for manufacturing process validation, and we're working diligently to mature these vehicles as we prepare to deliver pre-series trucks to customers in the fourth quarter of this year. One of our biggest challenges at the moment, no surprise to anyone, is the supply chain for the Nikola tray. As you know, the entire automotive industry is facing a global parts and material shortage, and the situation has only gotten more acute over the last 90 days. Our supply chain team is working diligently to overcome the constraints and to continue to grow our part maturity levels as we ramp up for pre-series builds and aim to deliver trucks in the fourth quarter. And as we mentioned in our previous earnings call last quarter, we have supplier confirmation for enough battery cells to build up to 80 trucks in the fourth quarter, but we're experiencing delays in receiving numerous other parts at this point. Particular concern are vehicle head units, crash sensors, touch screens, and other displays. And the common root cause for many of these is the worldwide shortage of integrated circuits and critical chipsets. And as suppliers continue to push back the receiving dates of critical semiconductor components, and as a result, our validation and testing timelines are subject to delay accordingly. As a result, we've got the manufacturing capability to build up to 80 trucks in Coolidge and Ulm in the fourth quarter, but we may not receive enough of those components by early December to deliver saleable trucks to regular customers. What we'll still expect to do is substantially complete these vehicles and place them in our dealers' demo fleets or with select launch customers, or even use them for our own freight needs to accumulate miles on public roads in the fourth quarter, even if those units are not technically saleable due to these critical components not being available to us in time. Meanwhile, at this moment, Tre fuel cell electric vehicle alpha prototypes are being built in Coolidge, 5 units there, and in Ulm, Germany, 2 vehicles there. This will be followed by commissioning and validation of these trucks in the third and fourth quarters this year. We're targeting a road release under limited conditions to start pilot runs with Anheuser-Busch between Los Angeles and Phoenix by the end of the year. The start of production for the Tre fuel cell vehicle is still planned for the second half of 2023. Looking forward from there, we're also still planning for the start of production for the ultra-long-range Nikola 2 fuel cell vehicle in the second half of 2024. We're very pleased that we've completed this first phase of the Greenfield Coolidge, Arizona facility. We're calling it Point 5, where we're currently building the 7 trucks we referenced, the 2 battery electric pre-builds and the 5 fuel cell alphas. And as we ramp up this first phase of the facility, we're concurrently building out the next phase, and that will significantly expand the assembly area and will bring our manufacturing capacity to an expected 2,400 units a year by the end of 2021. And then we'll begin phase 2 of the build-out in January of 2022 and complete that phase by the first quarter, into the first quarter in 2023. And at that point, we expect our nameplate capacity to jump to 20,000 per year in Coolidge. Things are moving with similar speed at our sister joint venture facility in Ulm, Germany, which is on the Iveco industrial complex there. The facility and building modifications have been completed, and all 32 of our automatic guided vehicles have been incorporated into the assembly line area, and they've been installed there. The accompanying equipment and tooling are currently undergoing calibration, and currently there are those 2 Nikola Tre battery electric vehicle gamma builds on the line being assembled. And we look forward to beginning pre-series production of the Nikola Tre battery electric vehicle in Ulm in the fourth quarter of this year. On June 22, we announced the purchase of a 20% interest in the Wabash Valley Resources Clean Hydrogen Project, now being developed in West Terre Haute, Indiana. This facility was originally operated as an industrial-scale gasification plant and is now being converted to a world-class hydrogen production facility with carbon capture and geologic sequestration. Wabash Valley Resources recently received significant government funding from the Department of Energy as part of its carbon storage program. The new plant will use biomass in addition to commodity petroleum coke to create clean and sustainable hydrogen, with the resulting carbon emissions expected to be permanently stored deep underground. As we previously explained, building out our hydrogen fueling system will involve leveraging three value streams: the on-site electrolysis-based hydrogen generating and dispensing stations, which we've talked about in previous quarters. Also, centralized hub production of hydrogen with spoke dispensing locations, which we've also talked about in previous quarters. And then hydrogen offtake agreements from other efficient and competitive projects. And WVR is an example of how an offtake agreement can provide hydrogen at or below the cost of diesel, especially in areas where favorable electricity rates may not be available for production by electrolysis. The WVR agreement will enable us to offtake up to 50 tons of hydrogen per day at a target cost of less than $1 per kilogram, helping pave the way for us to provide clean and affordable hydrogen to our customers throughout the Midwest. The location there in Indiana is a critical geography along highly traveled truck corridors. It's within 250 miles of major cities, including Chicago, Illinois, Milwaukee, Wisconsin, Columbus, Ohio, St. Louis, Missouri, and even Nashville, Tennessee, as you can see there on the map. On July 15, we announced an expansion of our sales and service network, adding an additional 51 locations spanning Texas, Arizona, California, Colorado, New Mexico, Florida, Delaware, Virginia, and Maryland. In conjunction with the Rig 360 announcement that we made previously in April, we now have a total number of sales and service locations at 116. And as you can see from the map on slide 10, we're well on our way to our ultimate goal of customer coverage from coast to coast. We are working on additional locations, which we expect will fill out the remainder of this map, and sales and service support are critical for our customers. Uptime and reliability are of the utmost importance to their operations. Along with the announced station collaboration agreement with Travel Centers of America, the hydrogen offtake agreement with WVR, and the latest expansion of our sales and service network constitute the building blocks of our bundled lease ecosystem. It's going to allow us to provide customers with the fuel to power their vehicles and the service and maintenance network that will be needed to keep their trucks on the road. I'll now pass it on to Kim, and he'll go over the numbers.
Thanks, Mark, and good morning, everyone. Before going over our second quarter results, I would like to provide some color on our agreement with Tumim Stone Capital, LLC. The agreement with Tumim provides Nikola with up to $300 million of additional liquidity. The purchase agreement gives us the right, but not the obligation, to issue shares of our common stock to Tumim at the market price minus a 3% discount at our sole discretion. This is a flexible liquidity solution, allowing us to issue purchase notices to Tumim when Nikola's stock price is strong and minimizing dilution to our shareholders. Moving on to our Q2 results, in the second quarter, net loss was $143.2 million, and on a non-GAAP basis, adjusted EBITDA totaled negative $73.9 million. Adjusted EBITDA excludes, among other items, $1, $52.7 million in stock-based compensation, $2, $11 million in regulatory and legal matters, and other professional services incurred in connection with the Hindenburg short seller article from September 2020. Fourth, $1.9 million in normal depreciation and amortization, and $5, $2.5 million loss on revaluation of warrant liability. The second quarter's research and development expenses were $67.7 million. including $10.2 million of stock-based compensation expense. R&D expenses consist mainly of costs incurred in developing, building, testing, and validating Nikola Tre battery electric and fuel cell trucks. SG&A expenses were approximately $70.7 million, including $42.4 million in stock-based compensation expense and $11 million in legal and regulatory costs. As of June 30, 2021, our total headcount was 630 employees, and it's growing rapidly as we continue to build our teams in engineering, manufacturing, and energy. Turning to the balance sheet, we ended the second quarter with $632.7 million of cash and cash equivalents. We have no outstanding debt as of June 30, aside from our Phoenix headquarters lease obligation. Our capital expenditures totaled $64.8 million year to date and are comprised of the construction of our Coolidge greenfield manufacturing facility and equipment, and investments in supplier tooling related to Tre BEV production. We ended the quarter with approximately 397 million shares outstanding. Weighted average shares, both basic and diluted, for the second quarter were about 394.6 million. Basic and diluted GAAP net loss per share for the second quarter was 36 cents. Basic and diluted non-GAAP net loss per share was 20 cents. Non-GAAP net loss per share excludes stock-based compensation, loss on revaluation of private warrant liability, and regulatory and legal matters. For the second quarter of 2021, we came in below our planned expense ranges as we continue to be laser focused on managing cash and disbursements. However, we are being aggressive in sourcing battery cells and semiconductor components, including paying deposits and higher prices to ensure allocation and shorten the lead time, if possible. Now, turning to our Q3 2021 guidance, estimated R&D is in the range of $90 to $95 million, including $10 million of stock-based compensation expense. Estimated SG&A is in the range of $65 to $70 million, which includes $43 million of stock-based compensation. Total estimated operating expenses will be in the range of $155 to $165 million, which includes $53 million of stock-based compensation. Our anticipated capital expenditures for the third quarter are $75 to $85 million. Moving on to our fiscal year 2021 guidance. As Mark previously discussed, depending on the receiving date of C-sample vehicle semiconductor components and subsequent validation and testing, saleable vehicles may not be available until early 2022. However, we intend to build and place pre-series Tre BEVs at our dealers for demo and in the customer's hand in Q4 2021 for freight hauling on public roads, if possible. Because some of these vehicles may not be saleable, we may not be able to recognize revenue upon delivery of the vehicles. Accordingly, we are revising our delivery guidance from 50 to 100 vehicles to 25 to 50 vehicles, and revenue guidance from $15 to $30 million to $0 to $7.5 million. The anticipated gross margin of approximately negative 190% will remain the same, but the gross profit could improve by approximately $6 to $10 million, mainly due to decrease in truck delivery guidance. Total expense guidance remains intact with no changes. R&D guidance remains at $318 to $328 million, inclusive of $40 million of stock-based compensation, and the SG&A guidance range is $252 to $262 million, inclusive of $169 million of stock-based compensation. Our anticipated capital expenditures for the fiscal year 2021 remain unchanged in the range of $210 to $230 million. Our capital investment plans include Phase 1 Coolidge manufacturing plant and associated manufacturing equipment, supplier tooling, hydrogen infrastructure, and fuel cell electric vehicle engineering equipment. Our anticipated ending cash balance range at the year end, if no additional capital is raised and Nikola exercises the full $300 million in 2MIN purchase rights, is $500 to $530 million. We are estimating total shares outstanding at the end of 2021 of about 418 million, and weighted average shares for the full year ending December 31, 2021 of approximately 413.5 million. This includes 1. Estimated employee stock option exercises, 2. Restricted stock unit distributions, and 3. Estimated purchase notices issued to 2MIN Stone Capital LLC. We expect that we will fulfill our hiring plan in the coming quarters. Our headcount as of July 31 is 705 FTEs. By the end of 2021, we should have approximately 1,000 employees, comprised of roughly 180 manufacturing plant employees and 820 corporate and engineering employees. We continue to move forward and execute our business plan despite challenging supply chain constraints. We look forward to achieving the following milestones in 2021. Deliver pre-series Nikola Tre BEVs for use on public roads hauling customer freight. Announce additional fleet testing, customers and dealers. Break ground on our first commercial hydrogen station and or centralized hydrogen production facility, and announce additional hydrogen infrastructure and ecosystem partners. This concludes our prepared remarks. We will now open the line for questions. Operator.
Thank you. At this time, we'll be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you'd like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Our first question comes from Chris McNally with Evercore. Please proceed with your question.
Thanks so much, gentlemen. So, two questions. I guess the first is really on the elephant in the room and Trevor's lawsuit. So, I think it's clear that the lawsuit is against the person and not the company, which is obviously a positive development. But one of the questions we always get from investors is, current management was obviously around at Nikola, next to Trevor when the majority of these, statements in question were made. So I guess my first question is, how would you answer that line of questioning to investors, and maybe, what other questions, or I guess said otherwise, do you think that you've answered, to the best of your knowledge, all of the statements that came out of the Hindenburg report, which started all this?
Thanks, Chris. Obviously, that is an elephant in the room, and appreciate you bringing it up first. As you mentioned, the approximately 100 pages of charges against Trevor are against Trevor personally, and if you read through those, you'll see that they all involve statements made by Trevor personally, and nothing the company said or filed, and nothing by anybody else at the company said or recorded was mentioned in the indictments. So we're very focused on our objectives going forward, This is a potential distraction. There's lots of potential distractions out there, and our job is to keep everybody focused on delivering on the milestones that we just overviewed for you.
Okay, great. And then maybe, on the second to business development, clearly one of the most important questions for investors, after the progress of actually building the BEVs is who's going to buy them and what's that level of demand. You talk about announcing additional launch customers, by the end of the year. Could you give an idea about what size order batches, we would expect to see? Are we talking about hundreds of vehicles ordered for a launch customer, thousands? Again, this is on orders as opposed to deliveries, just so we can have an understanding of how broad the order book may be by the end of the year.
Good question. Thanks, Chris. The current announced customer for the BEV is TTSI, and the current announced customer for the fuel cell, which is behind that, of course, is Anheuser-Busch. Those were very carefully crafted relationships and agreements, contracts that we have in place in both cases. We're not going to take any reservations, and we're not taking any hand raises or anything like that for the Tre battery electric vehicle. We're only going to be doing contracts, and of course for a launch customer like TTSI, we're asking them to do development work with us and to share risk with us. For example, as we mentioned, we'll place vehicles with TTSI even if they're not completely validated because of delays in receiving chip-dependent components. Because we need to start mileage accumulation in spite of this global parts shortage. So we're going to get trucks on the road. They're going to be hauling customer loads, and we're going to accumulate miles starting in the fourth quarter. But we have to be very careful who we partner with on that. Beyond that, we've said before that everybody is interested in these trucks. Everybody needs these trucks. Pretty much every customer I've ever talked to is willing to take trucks for evaluation and would like one. But what we're focused on now is major customers who are willing to make long-term commitments and sign broad-based partnerships with us. And so if we announce further, it's going to be likely on that front before we start opening up the order book and publicly disclosing who's going to be taking small amounts for evaluation, because that list will be very long. Remember that there's almost 4 million Class 8 trucks on the road in North America. There's more in Europe, and all of them must be replaced. And nobody's working on new diesel vehicles. So the undertaking that we've got here is huge. The need for a truck that is proven and can be produced in quantity is massive. So I'm not saying trust us on the demand, but there are some macro effects going on here. Everybody needs zero-emission trucks. Everybody wants them. What they want is one that's proven and they can get in volume, and one that's reliable, that's serviced and supported in the field. That's what we're building. We're building for the long haul here, no pun intended. We're building so that we have an ecosystem that's sustainable, that customers can rely on, and that we can partner with on over many years. That's our objective here. So you'll see further announcements. We're not rushing any of these things. Right now we've got plenty of people to take trucks in the near term. We're not producing in volume at first. We're ramping up slowly. And what we need to do is get these pre-series, actually assembly line produced trucks in customer hands and in our dealer hands. Our dealers will run them for their own purposes. Most of our dealers run their own fleets. And then they'll be doing demos for their customers. And they'll be representing us to most of the smaller customers in their respective geographies. And then we'll do more deals, most likely do more deals like TTSI and Anheuser-Busch as things come along. Right now, the trucks that we'll produce in the fourth quarter all have a home. And as we go forward, we'll announce further deals on those going further out.
Chris, we previously mentioned that by the end of this year that we will be in a position to disclose our backlog order book, and we intend to do that. As Mark talked about, there are dozens of conversations that are going with major customers now, and we anticipate as we continue to announce launch customers as well as other customers that we should be in a position in Q4 where we can start sharing
backlog and the order book with respect to our battery electric truck?
We've had many customers with us in the test track and validation facilities. They're seeing the trucks. They're getting rides in the trucks. They're getting a chance to review everything with us. We have great customer conversations going on, and we'll bring those to you and let you know more about them in due course.
Thanks. So to paraphrase, basically by the end of the year, we'll find out about the larger backlog, but basically launch customers, which will be selective. You're looking for long-term arrangements where they'll be sharing development costs and the ecosystem. And just the last one real quick is we should expect those launch customers primarily focused on the U.S. to start, and then maybe Europe is something for next year.
That's all correct. That's well said.
Okay. Thanks, guys.
Our next question comes from Jeff Osborne with Cowen. Please proceed with your question.
Yeah, good morning, guys. Just a couple of questions on my end. Kim, I was wondering if we can just go back to the cash burn. Can you talk about what the current burn rate is per quarter? And then the 500 to 530 that you talked about, is that assuming that all of the Tumen capital is exercised by year end?
Jeff, a great question. For the first 3 months, when we think about cash burn, we think about both from operating activities as well as from CapEx. And for first 3 months, in Q2, we averaged approximately $35 million. For the first 6 months, between operating activities and CapEx, around $31 million. As you know, we were highly favorable with respect to CapEx in the first half, and so in the second half of the year, we anticipate our CapEx burn will increase, and then by the end of the year, what we have stated is that in terms of all of our guidance with respect to OpEx as well as CapEx, we have not changed, and they will remain the same. And so we feel pretty confident about what we have forecasted, and then the ending cash assumes that if we were to exercise all of our put rights with respect to Tumen capital, we'll end with approximately $510 to $530 million of cash.
Got it. And then, Mark, can you update us on where we are with FMVSS and CARB certification? Is that something that you'll have before the fourth quarter so that you could start deliveries in a compliant fashion, or can you deliver prior to having those?
We can certainly deliver prior to that, but we're working as fast as we can. And the timing of that, of course, depends partly on the regulators and the bureaucracy that we're working with there. So I can't give you an exact date when everything will be in place. But we're working on all that very rapidly. As you know, California is a target launch geography for us for both vehicles. Both the fuel cell and the battery vehicles will be launched in California, or a combination of California and Arizona in case of the long-range trucks. So
but just to follow up on that,
we're looking on.
Sorry to interrupt.
Go ahead.
Just to follow up on that, in the event that you don't get CARB certification, by the fourth quarter, is there any risk to deliveries where people want the credit for that, and until you're certified, that they won't elect to take delivery?
No, I don't. We haven't heard anything in that vein. Everybody wants, and we want the trucks on the road. We need mileage accumulation at this point, so we wouldn't let that stop us.
Perfect. That's all I had. Thank you.
Our next question comes from Emmanuel Rosner with Deutsche Bank. Please proceed with your question.
Hi, good morning, everybody. I have three quick questions, if I may. The first one, can you give a little more detail around some of the critical components that are missing and that are difficult to source right now? What are the prospects for that supply to improve, and is it possible to use these? You mentioned using these trucks for testing potentially. So I guess just curious what sort of components we're talking about.
So the ones that we're worried most about are the ones that are dependent on chips. So that electronic components, sensors, touch screens, things like that. Those are the ones that we're most worried about. In most cases, we have the components we need to operate the truck, just not all the, for example, some of the displays might not be there because we don't have the validated, fully validated production versions of those displays on time, because all of that's delayed around the world for everyone, as you mentioned, and as you've heard from other OEMs. So we believe that we'll be able to finish these trucks. They won't be completely finished in terms of every single part, but it looks like there's a good chance they will be usable, just not saleable. We can't transfer titles. We can't put the official VIN number on them until they're saleable. But in that case, if they're drivable, then we're gonna put them in places where we can get mileage accumulation other than on the track. So that we've built 14 vehicles to date for testing and validation, but all of that mileage accumulation is on private property, mostly test track facilities or here at our own facilities. So we need public road mileage accumulation with customer load. So that's why we're gonna go ahead and place them with our dealers, who can put them in their own fleet or use them as demos with their own drivers, our trained driver or a dealer trained driver. And then we have select customers, TTSI is one, who are willing to get loads on the road with our vehicles for mileage accumulation purposes, even if they don't get to take title, at least not immediately. Our goal would be to retrofit those trucks when the parts arrive, and then some of them will probably become saleable at that point, and we can transfer title at that point.
Emmanuel, as we alluded earlier, we are doing everything we can, including paying higher price, as well as trying to improve lead time. There are two key critical components that, from C-sample perspective, likely will not arrive until late Q4. That would be vehicle head unit and display. So what that means is that we will have to validate and test, and depending on the arrival of those components, it may spill over to January in terms of final validation and testing before we can have saleable vehicles. And so what we're trying to do is bring that forward as much as we can. At this point, we cannot confirm that, but we are working actively with chip suppliers to make sure that we can accomplish that.
So what we do in that case is we'll put a substitute screen in there. It won't be the screen that's intended for production, but we put a screen in there for engineering purposes, and then the truck is operable, just not saleable.
Okay, that's great detail. Then secondly, focusing on another important component, the batteries. I think at the last update you had mentioned that around maybe June and July you'd have some of the conversations around sourcing batteries and available supplies for 2022. Can you give us any sense of how these discussions are progressing, and to what extent you may or may not be constrained on the battery supply for next year?
Sure. For Q4, I think we previously mentioned that we received confirmation for battery cell allocation up to 80 trucks, and so we should not have problem in terms of having capacity build up to 80 trucks other than component supply issues. Going to 2022, as we talked about, we are relying on more than just one source in terms of our battery cells, and we have been in negotiation with battery suppliers. I can tell you that those negotiations are going well, and we have recently started having detailed discussions with respect to battery cell supplier where we could receive significant battery cells, and we are obviously still working through, and as you know, the battery cell challenges will likely last through 2022 and potentially 2023, and what we have committed at this time for next year is approximately 1,200 battery electric vehicles. Of course, at this time, while we have not revised any guidance, ultimately we will have a better idea by end of Q3 in terms of what we have been able to procure for 2022. I can tell you that we're well underway at this time, and so we have reasonable confidence that we should be in a reasonably good position. But once again, we will know much better by end of Q3 in terms of what we have been able to confirm and the long-term agreements that we have been able to sign.
Okay, that's helpful. And then just very finally, Kim, can you just update us on how you're thinking about additional equity raise? What is sort of like the optimal or the needed timing for this? I guess is the capital from Tumim and then the slower sort of like ramp up. Is that sort of like enough to sort of like push this back a little bit later in the year, or is like the summer still the way you think about it?
Sure. And this is something that we are constantly thinking about. As you know, Tumim Capital equity line of facility, that gives us the flexibility so that we do have a longer runway. Having said that, we have always been clear about our intention to raise additional capital and go back out to market for a follow-on offering. And of course, there are many factors when we evaluate that. One, obviously, being market condition with respect to equity market as well as convertible debt market. That's something that we're evaluating. We also want to make sure that we try to optimize the timing as much as possible with respect to Nikola and the milestones. And right now, as you know, our stock price is somewhat weak, and so that's something that we'll definitely consider as we think about the timing. But as of now, our current thinking is still to go out to market in the second half of the year, whether that be towards the end of Q3 or potentially even early Q4. Right now, our intention has not changed, going back out to market.
Great. Thank you so much.
Our next question comes from Joseph Spak with RBC Capital Markets. Please proceed with your question.
Thanks. Good morning, everyone. Maybe just sort of another point of clarification here. You previously talked about delivery of the Tre BEVs later this year. Now you're calling that pre-series, and I get that it seems like that's because maybe there's some non-validated parts. But is that really what changed here, or was that always the case, and this is some new language that perhaps the lawyers sort of made you throw in there, or maybe you could just really talk about the change, and then the vehicles you're actually talking about delivering are fully like I guess sort of the prior defined deliveries. Like I guess I just want to understand the change in the language.
Yeah, that's exactly right. We're trying to distinguish between trucks that are saleable and VIN numbered because they're completely validated. Every part is there, and we can sign off on them. And those that we may be lacking one or more parts that are fully validated. So that's exactly how to look at it. This is the regular assembly line and the regular facilities. These are the trucks as designed for series production, but they may not be saleable, and so we'll call them pre-series until we are officially saleable.
But the 25 to 50 are pre-series, or those are the old definition saleable trucks?
They will be pre-series until we may be able to turn some or maybe potentially all of them into saleable trucks, but we won't know that until we get the parts. So. Okay,
so just to be clear then on the change. Before it was 50 to 100 saleable. Now it's 25 to 50 pre-series. Although you're hopeful that some of those can turn into saleable.
That's right. And we have the facilities. We have most of the components, but we're going to lack a few. At the very least, we'll lack the head units and the touch screens.
And what's the process on those? I mean, those are, I guess, these are still, I guess, somewhat, prototype. So what's the process here? Do they give you feedback, and then you sort of can go back and refine, or is this like, they go into sort of, customer testing and then they decide if they, want to place a larger order?
No, it's pretty straightforward, actually. They have to do their own testing of the component, which we have specified, and they have to prove to us that it meets all the requirements, including durability, shock, vibration, everything like that. So that the component has to meet its specifications from the supplier at the component level, and then we have to put it in the truck, and then it has to be in the truck for the validation and testing of the truck that would include that component. So what we'll get from them is their fully tested component, but it's late, and then we have to actually put it in the truck. That's why mileage accumulation is so important for us. We have to actually get it in the truck, and we have to get enough hours. And then in certain conditions, that test usually can only be done on a test track because it's such an extreme edge case or corner case of the use that we can only replicate that reliably on a test track. So that's the timing constraint here. Is we were planning to have all this stuff by certain dates in the master Gantt chart to be able to put those trucks off the assembly line and into customer hands, fully saleable with transfer of title. And we're going to be short certainly because of these components we just mentioned. There's possible other shortages too. There's a ton of shortage to go. There's lots of shortage to go around right now. This is the worst I've seen it in my career, over 3 decades now. The last time it was even close to this bad, I think, was back in 2009. And if past experience holds, it will turn faster than it became apparent. I think back in 2009, it was the July shutdown is when it turned. I think when everybody came back from the shutdown, everybody suddenly started placing orders, and suddenly we went from being nobody wanted anything to everybody wanted everything now. That was the opposite situation where demand had collapsed and then it recovered very rapidly. In this case, I think you could